everybody, and welcome back to the second episode of Stocks on the Rocks. We've got a lot to cover in this episode. However, before I get started, I did want to say thank you to everybody that came across and downloaded our first episode. It had over 500 downloads, which is just completely surpassing all of my expectations. So thank you for the support. Now, moving on, for those of you that are new here, my name is Chris. I'm a 32-year-old fundamental investor from the YouTube channel Compound and Everything. Now, in this episode, we're going to be answering some of the questions from our most recent Q&A thread posted on the Compound and Everything YouTube channel. We had over 50 questions submitted, and I won't be able to sort of answer them all in this episode alone. However, I do promise you that we will get through them all eventually. If anybody listening to this podcast would also like to ask a question, feel free to jump on over to YouTube and type one in the comment section below, or email me on compoundingeverything@gmail.com, and I'll be sure to include it in a future episode. So our first question comes from Kurt. Now, Kurt has asked, how would you start a portfolio today assuming you have $50,000 in cash to invest or less? Well, Kurt, that's a really, really good question and very relevant in times like this, especially when people can get money out of their super and things like that. I personally wouldn't be rushing into the market at this point in time. Now, for those that are listening, and you, Kurt, as well, I can't give you advice, of course, but I can generally answer this question as to what I would be doing. And what I would do at this point in time, if I was an inexperienced investor, is use this as an opportunity to understand the market a little bit better. Now, that doesn't mean you can't invest. However, it does mean that you might want to pick something that's a little bit more sort of a long-term base, something like a low-cost index fund. Now, I also wouldn't be rushing into buying that index fund with all of your $50,000. I would be dollar cost averaging in over the next, probably at this point in time, over the next 12 to 24 months, especially if it was a starting position with $50,000. So for me personally, I don't think the average new investor is probably going down the right path if they're trying to buy individual securities right now, unless they have really done their research, they understand the company, and they know what they're getting in for if things get a lot worse, and they very well could over the next 6 to 12 months. So my 10 cents would be potentially look at index funds, low-cost index funds, and maybe start dollar costing your way in with a small portion of that. If it was me, I might take $5,000 or $10,000 of it, spread that over the next 3 to 6 months, and then feel out what I'm comfortable with and what I'm not comfortable with. Because at this point in time, you really don't know what it is that you're trying to achieve as an investor yet. And an index fund, especially a low-cost index fund that is tracking a broad index, something like the S&P 500 or the top 200 or 300 companies in Australia, is going to be a reasonably safe investment if you're holding it for 20 to 30 years. Anyway, I hope that helps, Kurt. It's very difficult for me to answer a question specifically when it comes to your own situation, but that is what I would be doing if I was starting right now with $50,000. Now that takes us to our next question, which is from Thomas. Thomas has asked, what is your portfolio allocation for ETFs and individual stocks? That's another really great question, actually, Thomas. For me personally, I don't have a set rule, and the reason for that is because I like to be versatile in my approach in sort of what I'm investing in. So let's say, for example, that right now, if I was 50% ETFs, I don't need to maintain that 50% position. If I found a company I loved and I truly believed in, and I could purchase that company with a margin of safety and hold it for 20, 30 years, I would have no problems with that being my only investment. Now, why I'm hesitant to say that is because I do believe for the average investor, if you're not willing to put the effort into the market in the sense of researching stocks and really deep diving, which is perfectly fine, you don't actually need to, then diversification via a low-cost index fund is the way to go. But for me, I don't need to diversify. I have no need in diversifying my portfolio. I don't believe in diversification at all when it comes to somebody that is looking to beat or at least equate to what the market is returning over the next 20 or 30 years. However, that is very much a personal choice. So to answer your question, I think for new investors, you probably definitely want to be heavily weighted towards ETFs and safe, secure ETFs for that fact. However, for long-term investors that have done their research, understand the market, that is an individual choice, and I wouldn't put an actual number on that. So I hope that helps, Thomas, in regards to your question about ETFs and individual stocks. So this actually leads us to our next question, which is from Marie. Now, Marie has asked me, why did you decide to start a YouTube channel, and was this something you always wanted to do? Now, that's a great question, and I think it's relevant for both podcast and for YouTube. Because in the sense of YouTube, it is something that I've wanted to do for a very long time. I actually recorded my very first YouTube video in 2014, and I put it up on my YouTube account, and I never made it public. And I deeply regret not making it public because I've always loved this. I've always loved the idea of this. I've given Twitch a go in the past. I know some of the listeners on this podcast are some of my Twitch friends that have been extremely supportive in following my journey since Twitch. So in this situation, yes, I've always wanted to start a YouTube channel, and the same goes for a podcast. I've always been fascinated with the audio side of things as well. From being a young kid, I always loved recording and making short clips and using tapes to mix things up. So yes, I've always wanted to do this, and now that I've found it and I really enjoy it, I will continue doing this for as long as I can because I absolutely love it. So thank you for your question, Maria. That was a great one. Now, the next question comes from Henry. Henry has asked, regarding index funds, I hear a lot about not timing the market and how consistent investments will more or less guarantee steady returns over the long term. Looking at a stock like VAS dropping from around $90 previously to $76.70 today, would this not be a great time to invest for the long-term investor and see even greater returns than usual? Would love to hear your thoughts. Henry, great question as well. This is a hard one. I do believe that there is always value in the right index funds if you're investing for a long enough period of time. I mean, the numbers show us that. History shows that we are going to get anywhere between a 6 and 10% return on any given major index fund, whether that be Australia, the US, and a few others. So, yes, I do think that you possibly could obtain more value right now than you could have 6 months ago, obviously, because the price is lower than it was. However, then we start talking about timing the market. And if I think that you could obtain better value now, why wouldn't I think I could obtain better value in 6 weeks or 6 months if the market were to drop off more, which it may. So I don't like to get too caught up in timing the market. However, if I'm presented with an opportunity like I was a few months ago, or maybe 2 or 3 months ago in March, I do become a little more aggressive in my investing style with index funds. In saying that, what I did personally might be a little different to what most do. In February, when all of the news was kind of coming out about the COVID-19 situation and all of these things going on, I thought, well, look, we have been overdue here for a while for a correction or a recession, and there's a chance it might happen. So what I did was I created post-it notes that had discount margins on them from certain points in time. So at this point in time, a 15% discount on the Dow was $24,000 roughly, and a 15% discount on VAS was $74.80. So my goal was to start buying in increments from 15% down through to 30%. Now, I was lucky enough that the market actually did drop through all of those increments at that point in time for the Australian 300, or the top 300 stocks in Australia, which is VAS. It didn't quite get there for the Dow. I think we got down to 30%. However, I didn't actually take advantage of that because the dollar was so weak at the time, and my math just wasn't coming together on that at this point in time, and you have to get into sort of figuring out if the dollar works for you or not. However, with VAS, yes, I did more aggressively purchase throughout that period to the point where I probably dispersed 30% of my cash into VAS at that point in time, which probably added maybe 15% to my holdings. So yes, I definitely did take advantage of that period. However, I don't have any more of those post-it notes written out from this point forward. I've simply gone back to dollar cost averaging every month. You know, from these levels, it's very difficult to try and obtain what is going to happen moving forward. So I don't guess, I don't pretend to know. I simply just keep dollar cost averaging into these positions every month. Me personally, I'll be holding VAS and funds like it for 20 to 30 years, given that that fund continues to operate the way it has in the past, which there's no reason why it shouldn't. So thanks again, Henry, for your question. Great one. I hope that helps. Now, Elena has asked, what is the perfect 3-fund portfolio for you in regards to ASX funds? That's a great question. If I had to live in this hypothetical world of only being able to pick 3 funds, I would probably be picking a combination of VAS, a NASDAQ 100 tracking fund like NDQ, and something like IVV, which is an S&P tracking fund. I don't know what my portions would be in those 3 funds right now off the top of my head. However, those are probably the 3 funds that I think would return at a decent rate over the next 25 years. However, it really depends on your personal situation. So take that with a grain of salt, but I hope that helps, Elena. And thank you for your question. Now, our next question comes from A. Campbell, who has asked, what is the best investing strategy for those starting later in life? I've recently turned 40, no real debt, and starting my investment journey with around $5,000 spread across VAS, VGS, and ARG. Well, look, thanks for the question. I can definitely appreciate your situation. I can't, once again, give you specific advice. However, what I would say is that I do think in regards to index funds, being 40, 30, or 20 doesn't really matter. Yes, you gain some significant advantages going back to being 18 and using compounding to your advantage. However, from 40, you're still going to get that same advantage. You will still get plenty of compounding interest hitting your account over the next 30 and 40 years. So I do think that you're on the right path when it comes to ETFs. I think that it's probably something you should discuss with your planner and try and understand what your goals are and what you're trying to achieve. If it's early retirement, if it's just a safe retirement after however many years, whatever that might be. But I definitely think that when it comes to talking about VAS, you're definitely in the right sort of ballpark there. So yeah, definitely one to consider. Talk about with your planner and I mean, keep hacking away at it. I know it's tough. Even 32, I wish I would have just taken 50% of my wage from 17 and just pounded it into the stock market. But it wasn't meant to be. All we can do is move forward from now. So the next question comes from BM06days. Not sure what that is about, but that is the username I've got here in front of me. How much of your savings do you like to invest, is what BM06days has asked. That's a really great question. I don't have a set percentage. There have been times in the past where my income has been somewhat consistent, and I do have set percentages from that. However, being a business owner, which is where all of my income comes from, is 2 businesses, I don't have a set percentage, especially in times like this with COVID going on. Things can get pretty wild. So I save everything I don't need. That's it. I don't do the opposite. I don't take what's left over and save it. I will take all of my expenses. I will forward budget for the month and go, okay, this is what I can get by on, and everything else goes into my stock market cash account. If I get a big payment and I only need 10% of that payment for the business, at that point in time, 90% will go into my stock market account after I've paid myself and paid the tax and all those things. It will go through. So yes, I put everything I can into my stock market cash account. Period. It just all goes across. So I'm very lucky that several months ago, before all of this sort of started happening, that I decided to up my emergency fund from 3 months to 12 months. It was sitting somewhere around 5 or 6 months at that point, and I thought, no, there's a lot of uncertainty going on at the moment in business and in just the general economy. So I pumped that up to 12 months, and that's where it's sitting right now. I'm also lucky enough that offsets my mortgage. So it's working for me there. It actually saves me quite a bit of money every month. That allows me to pump a lot more money into my stock market portfolio cash account, which at this point in time is starting to get to the point where it's becoming frustrating that I can't invest those funds in the market because I just don't find value, but that is just the game we play. So to answer your question, no, I don't have a set percentage. It's as much as I can, as often as I can. So I hope that helps. Now, our next question comes from Ram. Ram has asked, what are good stocks for beginners? I'm looking at a long-term investment of 15 years plus or so. Please suggest a diverse portfolio with good return stocks. So I've kind of answered this question earlier on, Ram, in this podcast. I think that for a new investor, if you're a complete beginner, ETFs, period. It's going to be your safest bet. And then when it comes to diversification and good returns, it'll take care of itself. Obviously, I can't give you advice, but if I was starting afresh right now with no knowledge, except for the knowledge of what I'm saying to you right now, which is ETFs, I would do my research, I'd find the ones that I like, I'd make sure my planner agrees with me, and I would start aggressively purchasing them if my personal situation allowed for it. So I hope that helps, Ram. Now, the next question comes from Eric. Eric has asked, as a young person, 19, how should I seek advice on how to invest my money? That is a really, really good question because there isn't a sort of a one place where you can go and just understand everything, I guess. The first step, I think, would be to try and understand the market as a whole. Just try and gain a general understanding of how it all works and what's going on a day-to-day, monthly, yearly basis. And the best way to do that, I think, is by absorbing lots of different sources of content. It might be podcasts, YouTube, reading books and understanding the fundamentals surrounding investing. I think it's a combination of everything and just talking to people and understanding the market. Now, yes, if you wanted to go a little bit deeper, you could do courses online and maybe go and study a little bit more, but I think it's probably a bit extreme if you're just trying to understand the basics and the fundamentals. So I would recommend trying to collate a group of those sources, read some books. I recommend reading Warren Buffett Way, and if you love it and you're really interested and you want to move on to something more, I guess, advanced, you can go on to The Intelligent Investor, which will definitely twist your mind for a while and frustrate you, but it is a great book nonetheless. So yes, I think trying to just gain an understanding, don't rush into it, and take your time is probably the advice I would give you. So thanks for your question, Eric. Now, the next question comes from Srini. I think it's Srini. Sorry if I'm mispronouncing your name there. Srini has a couple of questions. The first one is, as a newbie investor, what would happen if you accidentally place a $50,000 buy order, which gets processed immediately instead of a $500 buy order, and you don't have enough funds to cover it? Okay, first of all, that's a great question. I know somebody that did this with $20,000 instead of $2,000 accidentally. It was somebody I was day trading with at the time. Simple mistake. I know that CommSec allows this type of thing where you can purchase a trade, but you don't have to settle the account for, I think, 2 or 3 days. I'm not sure. Look, the best thing to do is to contact the broker you have placed the trade through very quickly and get their opinion. The second best thing to do is, if you're in a position to do it, is to close the trade. If you haven't lost a huge amount of money, hopefully, or if things haven't gone crazy on that trade since you've placed it, close it. Just close the trade, settle the account. Obviously, this is something you should take up with your broker individually. Most of the time, they're going to work with you. I know in the person that I mentioned before, he spoke to the broker, and I think they figured it out with him, but he was in a position where he could kind of just cop that short term. So, and I think he actually did end up holding on to that trade for a couple of months. I forget now. But nonetheless, I would contact your broker. If all else fails, close the trade as long as you're comfortable in doing such. Back out and learn from the mistake. If you end up losing a bit of money, well, that sucks. But everyone has to learn somehow. And I know I've had experiences in the past where I've definitely had very sharp learning experiences. Now, the second part of that question was, what are your thoughts on investing in ETFs that are sort of based off physical gold, and do I have any other commodities recommendations? That's a great question. I don't personally invest in gold. Man, I wish I did. I loved it. How cool would it be to have like silver bars and gold bars sitting in a safe downstairs or something? It'd be awesome, but I don't. And look, there are a lot of fundamental people listening to this that might be a little bit older than me that love gold because they've had amazing returns on it, and awesome. I mean, you've done very well because it did. If you bought this back in the 60s and 70s, you've killed it. But that's not investing. That is buying a product and then the product's value itself has gone up. And when I say that's not investing, it's not investing in the sense of what we refer to on this podcast or on the YouTube channel, where you're buying something that you think is going to produce income for you and continue to produce income and earnings for you on a yearly basis. Gold doesn't do that. Gold is something that goes up and down based on what somebody else is willing to pay for it. Gold can't start a business. Gold can't run a business. Gold can't have customers. Gold is just a thing. And yes, it's awesome to look at. It's amazing to hold. We actually had a customer from one of my businesses that is in gold, and touching that 1 kilo bar and then the 400 ounce bar is just, it is just so awesome. But I don't buy it. I've always been tempted to just buy one of the 4 kilo, or I think they're 4 kilo silver bars, just to have like on my desk at work or something for fun. But it would have just been a waste. So no, I haven't. I don't think that you should stay away from gold altogether. I don't think that it's a horrible thing to purchase. I just don't do it myself. I mean, if your portfolio needs to have some kind of hedging plan that includes gold or silver or other commodities, I mean, I don't know, that's good. I mean, I don't do it myself. I'm not an expert at all when it comes to commodities. I just don't go down that path. I never have. The people that I learnt from are strong sort of advocates for sticking with what you know and doing that. And that's what I do. So sorry, I couldn't give you more advice on the gold there, but that's just my personal experience and my opinion. So thanks again for your question, Serini. So our next question comes from Robin. Robin has asked, why is the ASX so tied to the US stock market? And why does the ASX take so many signals from the US stock market on a daily basis? Robin, that's a really great question. I think the easiest answer is probably the most simple one here, which would be the US market essentially is an indicator for every market around the world for the most part. The main reason is that they are the leaders when it comes to companies that are kind of performing very well with very large market caps. So when people tend to sell off in the US, which sends the markets down, you're more likely to see comparative markets selling off on the same type of reasoning because they believe, well, crap, if Amazon just went down 50% or if the S&P 500 just went down 50%, then we need to be worried about the same problems they're experiencing there. And that's a very simple explanation for that, but the US stock market essentially controls the world stock markets. It's always been the case. Well, it's been the case at least for the last 100 odd years, and I think it will remain the case until either China or, well, just China essentially, becomes stronger than the US dollar. And I think that their market is set to overtake the American market in like the next 40 years or so, or 50 years. And then you've got India following behind them, which in one of my first videos I put up, you could see how America will probably actually be the third largest via GDP and overall market size by like 2060, I think it was. I need to double check that. But yeah, I mean, it's definitely heading that way. But for now, I mean, no, the US market controls most markets and they normally follow along. However, it is worth noting that there was a while there in 2017, because Australia had so much going on with the Royal Commission and all these other things, where our market actually wasn't following the US market for a good period of time. I think it was between like June and October 2017 where we were actually stuck in a range on the ASX 200 and pretty much all of the other index tracking funds. And that was because of, like I said, the Royal Commission and things like that. The US market was skyrocketing throughout that time. And for those that were more experienced at that point in time, you probably saw that as a massive indicator to buy the Australian market. But we sat around, from memory, God, this is going to stretch my memory. I think we sat around $5,700 throughout that period. We were floating between like 200 points either way or so for a good 3 or 4 months there. And America went up massively, thousands and thousands of dollars over that same period. And then, of course, Australia pumped up to 6,500 and then 7,000 odd after that point in the following year or two. So generally speaking, everybody always catches up or falls down with the US market. So I hope that answers your question, Robin. Sorry, it was a little long-winded. Now, the next question we have comes back to Shirley. And Shirley has asked, what are the pros and cons of investing in ETFs in Australia versus the US? If you started with a $10,000 portfolio, how much of a percentage would you place on Australian stocks versus US stocks? And what are your thoughts on investing in listed investment companies versus ETFs? Okay, so I'll start with the first question, which is, what are the pros and cons of investing in Australia and the US? And I think to answer this question, I'm going to keep it as simple as possible in saying that I think the only disadvantage right now for most Australians investing in the US is the dollar. Our dollar is so weak compared to the greenback. And at this point in time, that is what's stopping me from purchasing any significant positions in ETFs over there. It wouldn't stop me from purchasing positions in individual securities if I thought I'd found one that presented value. That's a different story. The dollar very rarely comes into play there when you're talking about a company you believe you can buy at a margin of safety and will grow over the next 15 or 20 years. However, when it comes to index funds, especially hedged and non-hedged versions, you do have to be careful with the dollar, mainly because our dollar does hold a little bit of uncertainty at the moment, not in the sense of crazy things are going to happen, but whether it will reach parity or not again in the near future is kind of a topic that's up for debate, and I'm by no means an expert, so I'm not even going to dive into that. But from what I've read and from what I understand, and from my basic analysis on if that percentage conversion worked for me over the next 5 or 10 years, it kind of came out a bit close for comfort right now. There was a dollar amount when I had written down my post-it notes on the Dow that I would have been comfortable buying in at, even if the dollar was at the point it was. And our dollar got down to, I think it was 49 cents or 47 cents at that point in time. There was an amount that I would have been comfortable buying the Dow at. However, we were quite a way off that point. In saying that, I'm personally extremely bullish on Australia over the next 30 or 40 years. One of the main factors behind that would be that we are due to double our population over the next sort of 40 to 50 years, which is absolutely incredible when you look at the economics of it. I mean, all companies listed throughout that period would benefit from the population of Australia doubling. So yes, I'm not overly concerned about not being able to invest in US funds right now. However, that's mainly because I just think that Australia is going to return pretty decent results over, like I said, 30 to 40 year period. So that brings us on to the final part of Shirley's question, which was, what are your thoughts on investing in listed investment companies versus ETFs? Okay, this is extremely controversial because I don't believe in most listed investment companies. There are some amazing ones out there in Australia. There are some really, really great ones. But statistically speaking, the odds are not in your favor when it comes to purchasing a listed investment company and outperforming the market. That's unfortunately just the fact of the situation. There are 20% of those listed companies that may outperform the market for you. So if you can find one of them, definitely get on board. But they're inherently risked to being involved in a listed investment company. They have costs, they take fees, they can sometimes be more costly and not as worth it for some investors. However, like I said, if you can find one of the good ones and get on board at a stage that is sort of you being able to buy in at a margin of safety and buy in sort of showing some value, then by all means go for it. But for me personally, I did find a couple in 2017 that I really liked, and then I didn't invest in them. Now coming through to sort of 2020, I don't feel the need to purchase listed investment companies at this point in time. I think I'm happy with my index funds and individual securities. If I were to be in a position where I couldn't actively manage my portfolio, then yes, maybe I would consider swapping some individual securities for listed investment funds if I could find the right ones. But no, it's not really something that's on my radar at this point in time. Anyway, Shirley, thank you very much for your question. I definitely appreciate it. Now, this next one will be our last one for this episode. This question comes in from Sean, who has asked, could you please discuss Bubs in your podcast? Now, for those of you that don't know, Bubs is a security listed on the ASX called Bubs Australia, and they work in the sort of infant formula space in regards to a very niche type of infant formula that comes from the production of goat's milk, or comes from goat's milk, I should say. Now, it's actually really interesting that you have written this, Sean, because I've never spoken about Bub on my channel before. However, I did previously have a very large stake in Bub, and that was not from a fundamental perspective at the time. This was when I was day trading, and I thought I'd found and ended up getting, well, I believe very lucky in this trade with Bub from their early days. So first of all, yes, thanks for this question. I'm happy to chat about this a little bit. In regards to Bubs, like I said, I do have a bit of history with them. This stock was one of the penny stocks that really flew in 2017. And to be fair, has had its ups and downs since then, and probably more ups and downs for the most part. I mean, they've set new highs now almost every year for the last, I guess you'd say 3 years, give or take. When I first purchased Bubs, I purchased them at 19 cents. And I think my final trade in the company was around 90 cents to $1.10. I do remember it being slightly above $1, so it was somewhere in that range. To this day, it is still my biggest single trade. I will always have a place in my heart for Bubs. However, there are a lot of reasons why I don't invest in them now. And like I say, all of the time, there's a big difference for me when it comes to fundamental investing and a speculative play or just a trade. The volume that was going into Bub, and for those that don't know, I haven't spoken about this a lot, but most of my trading in 2017 was volume trading. The volume that was going through Bub was just incredible in the early days. There were a couple of spikes, and I did a bit of research, and I'll get into that research soon. And I just thought, I'm going to dip my toes in here and have a bit of a play around with this one. And in the end, it ended up being my largest position, about 90% of my trading portfolio at that time, which is a massive mistake. I was a complete rookie in the day trading game at that point in time. And it was a massive mistake, but it paid out. I got completely lucky. And at the time, they had some really crazy volume going through, like they said. So I thought, you know what? I'm going to do a bit of research into these guys, not that it really meant too much, but I'm just going to see if their story aligns with what I think will lead to more volume throughout the next couple of months. So I thought I'll sit down, I'll make a bit of a report and figure out what's going on with this company. So I'd heard that they had recently landed a contract at the time in 2017 with, I think it was Coles, it might have been Woolies, but I'm pretty sure it was Coles, and a heap of other little stores. And I thought, well, you know what, I'm going to call Coles and I'm going to see what the traction's been like at that time. I thought, I wonder if these products are actually moving off the shelf, because my local Coles didn't stock them yet. However, it did end up coming in a few weeks later. So I was calling Coles all around Sydney and Melbourne and other parts of Queensland and chatting to people. I was just calling and going, hey, I'm just wondering if you've got this product in stock. And then as soon as they said yes or no, I would chat to them about it. I'd go, oh, well, look, is this popular? Do I have to worry about getting down there quickly? Or whatever it might be at the time. And most of the time, I'd say 50% of the time, they didn't know about the product at all. They'd have to look it up on their computer. And then there was sort of 50% of others that did. And they said, yeah, we've had a lot of interest in this product. People are very interested in the goat's milk and all these types of things. And it got me thinking, so I probably did that for about 2 weeks. I probably called every Coles in Australia, the ones that picked up their phone anyway. And in the end, I did gain a bit of a understanding of how the product was moving. And by the stage I'd finished those calls, it was in my local Coles. Now, I wasn't going to go in and buy a tin of infant formula or anything, but I did want to have a look at their marketing and packaging and just see what the feel was like. Because as an entrepreneur, I believe that the product is everything. If you present it right, you've got a much greater chance of being successful. And one thing that Bubs did very well was, and still does very well from what I understand, is present their product very well. They've put a lot of effort into their marketing, they've put a lot of effort into their design and branding and their packaging. So I did buy, I don't know, at the time, I think it was like a baby snack. It was a liquid form baby snack. And I even ate it, and it was pretty good, actually. I didn't mind it. But at the time, I thought, look, I wasn't a fundamental investor at that point, and I was a speculative player. And I thought, you know what? I think these guys are just going to have a huge amount of interest in them over the next 6 to 12 months. I think it's just the hype train. At that point in time, A2 was going through the roof. Everybody, all of these penny stocks were just going crazy, and I thought this one is going to go. So I ended up buying a large portion. I think my first trade was at 19 cents, and that was not too much. And then I ended up purchasing a lot at around 21 cents. And my first trade in the company was from 21 cents to 43 cents. It was my first bag in day trading. And then from memory, I think the price may have dropped off slightly. It wasn't a lot. And then I came in again. And at this point, I was doing what most day traders would call was chasing. I thought, you know what, I sold too early. I need to get back in here. I've made a mistake. And this is a very big mistake that a lot of traders make, especially day traders, because you're chasing that next trade, and it's a really unhealthy thing to do. It normally results in losses. So At that point, I bought back in, I think, at around 29 cents the second time with the whole position that I had doubled previously. So, not just my original position, I had put everything back in there. I think from memory, that is where things got wild. I think the share price over the course of a month or two went well above 50, 60, 70 cents. I forget now. I know I doubled my money again. And at this point in time, I just thought, wow, what is happening here? This is wild. And keep in mind, this was my first big day trading play. I'd been trading for 4 or 5 months full time before this as a day trader, and it was always small plays. It was always I was trying to be very smart and do things the right way, how I'd learnt, and this was like I threw the rule book out the window. I'm like, I'm just going to have a crack here. And it was probably from frustration, not being very good at day trading, which I wasn't very good at day trading, in the sense of actually understanding the art of day trading. I just got very lucky and made good profits. It wasn't because I really understood day trading as a whole. My whole theory for the late half of 2017 was I just played volume. I would watch for volume signals and I would get in and I would ride 5 or 6 points of a trade and then I would jump out, and I would always be over leveraged in the sense of having way too much of my portfolio in the trade. I'd go up a couple of points, normally, like, it depended on the stock, but it could be anywhere from 1 to 10%, and then I'd be out. And I just did that every single day, and that's all I would do. And in the end, I was lucky enough to have a lot more wins than losses. But in the sense of Bubs, it was very kind to me. I think I ended up selling out completely around 60 cents all in all. I'd probably ended up turning my original investment into 4 or 5 bags, and it was just insane. It really took my capital to the next level when it came to day trading. I found that it was a bit easier after that point because I didn't have to go as deep in the sense of putting so much of my portfolio in. However, since that point, I always look back, over the years and thought that 19-cent position would have been, from memory, I think my 19-cent position when they hit $1 would have been $1 million. And that would have just been incredible. And my wife always says it, and I always say it. Oh man, I could have just helped Bub. But that's the game you're playing, and that's why I'm not a day trader anymore. I'm a fundamental investor purely because it's a hard game to be part of. Anyway, I've gone way off topic here because Bub is such a huge part of my story as why I'm not a short-term investor anymore and a swing trader or a day trader even. They are probably one of the biggest reasons. And I think that if I were to summarize this company, to answer your question, what do I think about Bub? I think that their marketing is fantastic. I think that their idea is fantastic, but I am worried about the niche that they're in. I think that they've done all of the right things. However, I have a lot of concerns. The reason I wouldn't take part of my portfolio that is for speculative plays and invest in Bub is because I don't actually believe wholeheartedly in the company. And I think there's a couple of reasons for that. The first would be, and this is more recently, the first would be that I'm a bit worried about the director selling shares. That's a little bit odd, and I don't know when she started, but I do know that this year that she has been selling off shares, and as a director of a growth company, I find it odd to not believe in that product. And when you're selling shares, there has to be a part of you that doesn't believe in it. Now, that doesn't mean that she doesn't have some sort of personal situation or something going on in her life that demands her to obtain capital. Now, of course, who am I to judge that? That does not mean she doesn't believe in the company. That does not mean she's not working 20-hour days for them. So it's not always as simple as, well, director selling shares, everyone should get out. I don't think that. But I would like to, I guess, if I was a shareholder, I would like more clarity around why the director was selling shares. And truthfully, I mean, maybe that's none of my business. Maybe that's none of the shareholders' business if it's a personal matter. But it's a fine line, and I'm not sure if that would be a bit of a red flag to me as an investor if I held Bub, which I don't hold any Bub right now. And the second reason is that I'm a bit worried about their growth and how they go about it. And this is the thing, I don't know enough about the internal workings of Bubs. I have never put so much energy into a company and researching a company as I did into Bubs at that time. I literally was on this for 6 or 8 weeks every day, calling people, talking to people, trying to understand the product, seeing what was going on. I called their reception desk and I'd be like, "Hey, can I talk to somebody there? Let's chat." All sorts of things. They probably would remember me, in the sense of that annoying guy that was calling asking questions, because at least the receptionist would, because I really wanted to try and understand the company, because when I was starting this journey as a day trader, I'd already been investing for a very long time before that. I'd probably been investing for 8 or 9 years as a very passive, I guess you could say, standard investor, someone that just was buying the typical stocks or funds and forgetting about it, and that was it. So when I found Bub, I was kind of excited. I saw this company and I saw this brand, and I'm like, wow, this is rare in Australia for someone to be to in their first year. They from memory, they'd approached a marketing company, a pretty decent marketing company, who had put together all of these designs and all of these sorts of bits and pieces for them that I thought really worked well. And I have a design company, so when I see good design and truly wholesome design that has been made for that company, it's not templated, it's not something that they just threw together in a second, you go, well, they actually care about this product. Even if they just care about selling it, they care enough that they have gone and approached people that know what they're doing. And that was always a massive tick for me, even if nothing else aligned. However, I was always a bit worried when I walked into Coles. They didn't have the best placement, and of course there are so many other products in that infant formula section that have priority. I think you got A2. If you got A2, and you've got a heap of other ones there that seem to have more prime time locations, and that is obviously because the demand for them is greater than it is for Bub. But I always thought, if I was in one of these types of businesses, my sole job, if I was in marketing, would be to try and convince these stores to put my product in a more prominent location. And even if it wasn't Coles, because there's not, you don't have a lot of pull there. They've got thousands of products and thousands of different people talking to them, and it's a hard business to go, hey, just put my stuff out the front, please. But in the chemist, in all of these smaller shops or businesses that stock these types of products, you want them at the front door. You want them at the counter. You want them a big stand that has something saying, "Hey, we're here." And I always get a little bit deterred by companies that don't seem to put the effort into doing that, because getting in on a ground level with a product like that is in my mind fundamentally critical for a company in Australia. And that leads me to the next point, which is, I feel like although they definitely care about growing in Australia, I feel like their intentions would try and do what A2 and some other companies did in getting to China. And I understand why. It's a huge market. It's a massive market. And their products could be more tolerable for that demographic, being goat's milk. However, that path always seemed a bit muddied to me. It always seemed difficult and challenging, and I always thought that was a massive uphill battle for them to try and enter that space. And I know they have entered that space, and I know a large amount of their sales come from that space. But I'm just not sure how long investors can hang on to, well, hopefully this grows over there, because it doesn't seem like, and like I said previously, I haven't put a heap of work into these guys in the last 6 to 12 months. So if I'm wrong here, please correct me in the comments or wherever you can. Email me on compoundandeverything@gmail.com. But it doesn't seem like they are putting the effort in here locally like I would expect, and like you see from other companies that really do. I mean, here's an example: Afterpay. Afterpay makes sure that merchants have their names displayed prominently if it's in a retail store. You walk past in any of the major malls and you see Afterpay stickers and Zip stickers on the windows. You know when the products are you know when the service is available within that store. And that's what you want from a company that is trying to really expand. You want there to be a presence. If they don't have touch points, what do they have? If Bub is just sitting on a shelf in Coles or on the bottom shelf in some random chemist down the road, then who knows and who cares? And I'm not saying that Bub haven't put effort into this area. I don't know. I just haven't seen it myself. And if I haven't seen it, I put in all that research back then why is somebody that has a baby and is rushing around with less sleep and less time going to care in searching for that product if the company isn't presenting it well enough. So anyway, that's my 2 cents on Bub. I find them a very interesting company. They still hold a very, very, very close spot to my heart because that trade definitely took my portfolio to the next level. To this day, I know it was absolute luck. It shook me in so many ways after that because it really woke me up to realize when I finished that buying and selling that company. And I sat down months after other trades and other things that may have gone well and some didn't go so well. I thought, how did that happen and how did it play out? And although I liked the product, I did my research, it was ultimately luck. And that led me to my new investing strategy and what I've been practicing now for the last 3-4 years. And the reason for that is just because I truly looked at it from an unbiased standpoint and realized that you just made that money from luck. Yes, you may have done some outline research that may have pointed you in the direction, but it was luck. That the volume could have turned out to be false. The indicators you were using could have been, they could have been showing anything. I didn't have the experience at that point in time to know. So from my perspective, I think that, like I said, I hold Bub very dear to my heart, but I would not be buying them myself right now. They are massively overvalued fundamentally, and there is so much uncertainty between Australia and China and trade at the moment. I mean, and that could blow over. That could all be nothing, and it probably will be nothing. But it's not for me right now. There's no way I would get back in there, not even for a trade. And I've been tempted because if you look at the Bub chart, you will see that range. And when they go down, they often very much go up. In fact, I don't think there's been a time since 2017 where they've had a big sell-off and they haven't had a big buy-up after it. It's a very interesting stock to watch and to trade, but that's not what I do anymore. And no, I'm not interested in Bub, and I think that anyone that would want to make sure that they had a risk tolerance for that type of stock, because it is definitely a high risk play. Anyway, Sean, thanks again for the question. I hope that helps. I know I rambled on a lot there, but there was a lot to say about Bub. If you guys have any questions, or maybe you'd like a video on compounding everything dedicated to Bubs, I don't know. Feel free to comment. If you're watching this on YouTube, comment below. If you're listening to this, you can always send me an email on compoundingeverything@gmail.com. Anyway, guys, that does bring us to the end of episode 2 for Stocks on the Rocks. I appreciate you guys getting all the way to the end here. I did want to keep this under 50 minutes, and I think I have done that. So thanks again, guys. If you haven't already, feel free to give an in-app review. It just helps me get out there a little bit more. To all of you guys that listen to this on YouTube, thank you. You're all amazing. Thank you guys so much for the support, and I will see you again next week. Cheers, guys. Have a good one.